January 2020. A short seller publishes a devastating report. Luckin Coffee has been counting customers that do not exist, selling coffee that was never made. The stock collapses 80% in one day. American investors lose billions overnight. 4,000 stores. In 18 months. More stores than Starbucks opened in Qian in 20 years. Billions raised from American investors. Millions of cups sold every single day. Almost none of it was real. This is Luckin Coffee. The fastest growing coffee chain in history, and the most audacious stock market fraud China has ever produced. In 2017, China had a problem. Starbucks dominated the premium coffee market. Chinese consumers were drinking more coffee than ever before. And no Chinese company had managed to challenge Starbucks on its own turf. Then came Luckin, founded in 2017 by Qian and Charles Lu. Luckin had a radical strategy. No sit-down cafes, no comfortable armchairs, no relaxing atmosphere, just small pickup kiosks everywhere. Office buildings, universities, shopping malls, everywhere Starbucks was not. Order on the app. Pick up in 3 minutes. Coffee at half the price of Starbucks. The strategy worked. By 2019, Luckin had over 4,500 stores listed on NASDAQ. In May 2019, raising over $500 million from American investors, the stock soared. Analysts celebrated Luckin was the future of coffee in China. But behind the beautiful growth story, something had been wrong from the very beginning. Luckin was not just subsidizing coffee to gain customers. That was real. Luckin was fabricating customers entirely. Here is what was happening. Luckin would create fake corporate customers shell, companies that appeared to be buying large volumes of coffee vouchers. That these fake sales were recorded as real revenue. They inflated Luckin's transaction numbers. They inflated its revenue figures. They told a story of explosive growth. American investors desperately wanted to believe. The numbers were simply invented. $220 million in fabricated sales. The fraud was exposed not by regulators but by a short seller. In January 2020, an anonymous research report was published by a short-selling firm called Muddy Waters. The report was based on months of ground-level research. Employees stationed outside Luckin stores, manually counting customers and orders for thousands of hours. The numbers did not match what Luckin was reporting to investors. Not even close. Luckin dismissed the report, called it baseless and misleading. Its stock barely moved, but the investigation had begun in April 2020. Luckin itself announced that its own internal investigation had found that its Qian Liu had fabricated approximately $220 million in sales transactions. The stock collapsed 80% in a single day. Trading was halted multiple times. American investors who had trusted the story watched their investment disappear overnight. Luckin was delisted from NASDAQ. In June 2020, that Securities and Exchange Commission charged Luckin with fraud. Luckin agreed to pay a $180 million settlement without admitting wrongdoing. What happened to the executives? In China, several were investigated by Chinese regulators. In America, the consequences were more limited. No Luckin executive was sentenced to a Western prison. The company itself remarkably survived under new management. Luckin restructured, repaid its debts, and continued to grow in China. By 2023, Luckin Coffee had become the largest coffee chain in China by number of stores, surpassing the company that committed massive fraud against American investors. Became more successful after the fraud than it had been before. So what is the real lesson of Luckin Coffee? American investors wanted to believe in China's growth stories so desperately that they ignored warning signs that were obvious. A company growing at impossible speed. Metrics that defied every known rule of retail. An entirely app-based business with no reliable independent verification. The Muddy Waters report existed for months. The fraud was confirmed. The stock barely moved when it was published, because investors did not want to hear it. The lesson of Luckin is not about China. It is about what happens when writes due diligence, when the story is too good and nobody wants to be the one who questions it. That is the capital case. Every fraud needs two things to survive: a fraudster with a story, and an audience willing to believe it. Subscribe to The Capital Case because the next case is already waiting.